By now, we've gone over a few lessons on how to build your portfolio. A major factor in growing it over time is how you fund it. Some investors may deposit a lump sum into their account and only use that initial deposit to reach that investment goal, without making any more deposits. However, most plans, especially long-term ones, should consider regular, ongoing deposits to help speed up portfolio growth. For example, you may want to deposit your yearly bonus on an annual basis, or $25 from your bi-weekly employment paycheck. In this lesson, we'll explore some of the funding options to consider for your plan. Before you can purchase any investments, you'll need funds available to cover all or part of the transaction. And if you're a new investor, keep in mind that when you make your first investment, you'll need enough funds in your account to cover the entire purchase, including any commissions or fees. For example, if you're purchasing 100 shares of a stock that costs $5 per share, then the total cost that you'll have to pay is $500, plus a commission fee of $9.99. That gives a total of $509.99. There are many different ways to fund your portfolio. For example, you can set aside a portion of your disposable income, use funds from your savings, borrow funds from family members, or you can get a loan from a financial institution. If you do this, though, make sure you're comfortable with the additional interest you'll pay for the loan. A quick note on borrowing funds to invest. Ideally, this should only be done if you want a return on your investments that's greater than the interest rate you'll be paying for the loan. While you can potentially make more when investing with borrowed money, your risk increases too. This is especially true if you invest in a product where your principal amount is not fully protected. If you're new to investing, you may want to start off with your own funds before considering a loan. Once you figure out where your investment funds are coming from, the next step is to decide how those funds will enter your investment account. There are a few ways to go about this. If you're an investor who wants to make sure that you stick to your investment plan, you may consider ongoing, automated deposits. There are a couple of benefits to using automatic, periodic deposits rather than depositing one lump sum. First, having an automatic deposit may remove the urge to use any extra savings you might have on something else, like impulse shopping. Second, you may be able to invest sooner. Let's say you're planning to deposit $1,200 in one lump sum 1 year from now. If you're able to start sooner with smaller monthly deposits of $100, then you can start to immediately invest this amount and possibly earn a return on these smaller amounts. For example, if you place these deposits into an investment that gives you a 5% return, then after 12 months you will have $1,200 plus about $32 in interest. Let's review a couple options to set up these deposits. Pre-authorized deposits, or PAD for short, allows investors to make fixed, periodic dollar amount deposits from their bank account into their non-registered investing accounts, like cash or margin. A monthly contribution plan, or MCP for short, is the same as a PAD, but deposits are applied to a registered account, like a registered retirement savings plan or a tax-free savings account. A deposit into a registered account is called a contribution. That's why it's called monthly contribution plan. Setting up pre-authorized deposits or a monthly contribution plan is a simple way to automate savings and set aside an amount to put towards investments. Let's look at another example. Matt wants to save $10,000 in 3 years to use towards a dream vacation. To start, he makes an initial $500 deposit into a TFSA account to purchase an investment that pays 5% interest annually. To ensure he achieves his short-term investment goal, he sets up a $300 monthly contribution plan. This allows him to have just over $10,000 in 3 years. For investors who have a particular interest in mutual funds, they may consider creating a systematic investment plan, or SIP for short. This allows investors to regularly purchase a set dollar amount of a mutual fund on a specific day each period. Setting up an automated amount can work for someone who would prefer to gradually buy in or invest in a mutual fund, rather than pay for their investment all at once. This practice is a form of dollar cost averaging, which we covered in our lesson on investing strategies. A systematic investment plan can be combined with a monthly contribution plan or pre-authorized deposits. This can allow the mutual fund purchase to be completed shortly after the deposits are made into the account. For example, Lisa is on a tight budget, but she still wants to maintain her investment portfolio and build up her investments over time. She uses a systematic investment plan to put $250 towards her desired mutual fund on the first day of every quarter. This allows her to grow her investments in the long run. Now, what if you're an investor who isn't interested in setting up automated deposits? There are different ways that investors can make lump sum deposits. The easiest way is to transfer funds from a TD Canada Trust banking account into a TD Direct Investing account through WebBroker, EasyWeb, or by speaking with an investment representative. These transfers are usually reflected in your TD Direct Investing account right away. You can also set up TD Direct Investing as a payee with a third-party bank. Once that's done, you can send a transfer using their bill payment feature. These transfers usually appear in your account within 24 to 48 business hours. You can also visit a TD Canada Trust branch to deposit cash or checks. Keep in mind, though, that some types of deposits, like personal checks or bank drafts, may apply a hold until the deposit is cleared. The hold might last a minimum of 7 business days, and your funds won't be available for trades until the deposit has cleared. What if an investor wants to transfer funds from an account at another financial institution into their TD Direct Investing account? If cash is readily available, this can be done by check. However, if the account already has investments in it, then you can initiate an in-kind transfer request through a TD representative, either on the phone or in person at a branch. The major benefit of this type of transfer is that any existing investment holdings could be transferred in kind or as is, without being sold. Generally, this type of transfer may take up to 10 business days to complete. It could take longer, depending on the institution that the transfer is coming from. If you have funds sitting in different financial institutions, there may be advantages to consolidating them into one. Having a single login for multiple accounts can be easier to manage. It allows you to have a complete view of your entire financial picture, rather than trying to piece together information from different sources. Also, when you have more assets within the same financial institution, you may qualify for additional benefits, like preferred interest rates or reduced account fees. In this lesson, we reviewed different ways you can fund your portfolio, and we took a look at some different funding strategies. Once you've funded your portfolio, the next step is to look into how to construct it by placing your first trade.